Welcome to Accounting in Focus. Today we're going to do a cash flow statement. And if you're looking for basic information about the methodology behind cash flow, talking about what goes into what account or what section, go back and watch my other cash flow video on cash flow basics. Okay, this video we're going to really spend some time actually going through and filling out the statement of cash flow. Okay, so you have before you, you've got a balance sheet, okay, for KLI Inc. for 2012 and 2011. We have to have 2 years worth of balance sheets in order to be able to do a cash flow statement. And we have some additional information. So let's go through that additional information. This is probably the first thing that you should do when you're doing a statement of cash flow, just to make sure that you understand what information you're given. Okay, I know a lot of times, right, we just want to jump in and start doing the cash flow statement, but if you take a couple minutes and read through the additional information first, okay, when you're trying to go through and explain the differences and why things are happening, you know, you'll have that information in your head. You'll at least go, oh wait, I think I read something about that. Okay, so let's go through this real quick. I'm going to underline the things that, I think are probably important. So let's go through. All right, so I've got net income. Let's see here. Oh, I don't have my pen on. There we go. Pen's on now. Okay, so I've got net income of $10,000. Underline that. The company purchased $5,300 worth of furniture. Okay, so we purchased $5,300 of furniture. And how did we purchase it? Oh, with a note. Okay, so we didn't actually spend cash on this one, so maybe that'd be a good no cash. Okay, so I'm just going to put that note in there so that way we've got it. All right, the company sold furniture. So we sold furniture with an original cost of $2,000 and accumulated depreciation of $1,200. That's probably all useful. For $1,000. Okay. Like I said, we'll go through and explain, but I'm highlighting things, so that way they're quick and easy to find as I'm going through doing my statement. So we repaid $2,700 on notes. Okay. So that's a note payable, right? We have a note payable account, so that's important. So depreciation expense was $2,400. And the company paid dividends to its shareholders, which was the only decrease in retained earnings. But notice it doesn't give us the amount. I'm going to put a question mark there. We don't know what the amount is. Okay? So we're going to have to figure out where that's important. So in order to be able to do a cash flow statement, you have to have a really good grasp of both the balance sheet and the income statement. Okay, if you don't have a good grasp of those items, you need to go back and you need to study them, because if you don't understand what these accounts are, okay, if you don't know what accounts receivable is and you're trying to do a cash flow statement, it's going to be tough. All right, so now that we've got that, okay, I've also typed in my heading, right, so I can start my statement. Remember, whenever you do a statement, you always have to put the heading on top. So the name of the company, the name of the statement, and the date for which we're doing this. All right, so when you're doing cash flow, you've got 3 sections. The 3 sections of the cash flow statement are the operating section, and hopefully I'm going to leave enough space here. Operating, and I'll leave myself some space. Investing, and financing. Okay, so these are my 3 sections: operating, investing, and financing. If you're having trouble remembering those 3 sections, I always tell my students, what sound do you make when I ask you to do cash flow on a test? You say, oif! Oif, Professor Ingram, don't make us do a cash flow on the test. I say, no, we have to. Okay, so remember oif. Okay, now what we're going to do is we're going to go through each line on the balance sheet, line by line, and explain why the differences took place. Okay, so we have to explain why we have a difference. Now, I'm going to put here just so that you know that this is my difference column. Okay, so this is the difference between the 2012 and 2011 balances for all of my accounts. Okay, so we've got our differences, we've gone through all of our information, so let's start the cash flow statement. Okay, so first thing that we want to do is we want to put our net income under the operating section. So let's write in net income, and my net income is $10,000. Okay. All right. Now that we've got that, let's proceed through the balance sheet. So first line that we're going to deal with is accounts receivable. Remember, the point of the cash flow statement is to determine our change in cash. So cash is actually the last line down at the bottom. So we're going to start with accounts receivable. My accounts receivable, the change is $800. Okay, it decreased by 8. So let's think about what section would you put accounts receivable in. Think about your rules. Okay. Changes in current assets or current liabilities go in the operating section. Okay. These accounts have direct ties to my operations. So if you think about accounts receivable ties directly to my sales. So I'm going to put decrease in, I'm just going to put AR for accounts receivable. And let's think about what happens to my cash. So if my accounts receivable goes down, why is it going down? It's going down because I'm receiving cash from my customers, right? They're paying off their balances. So if they're paying off their balances, that means my cash is going up. So a decrease in accounts receivable leads to an $800 increase in my cash. Okay. All right, so that one's done. Let's cross that out. Okay, next one, prepaid insurance. Okay, prepaid insurance. Well, what happens to prepaid insurance when it expires? It becomes insurance expense, right? So this also goes in operating. So increase in prepaid insurance. Okay, so an increase in prepaid insurance. So what happens? So I paid more of my insurance in advance, right? So essentially what I'm doing is I'm increasing another asset. And how do I do that? That asset increases because I'm using cash to pay for it, right? I pay for my insurance with cash. So if I have an increase in the balance, that decreases the amount of cash that I have. So I'm going to subtract $1,200. Okay, that decreases my cash. Okay, so now let's go down next. So that line's done. Next line, furniture and fixtures. Now I remember reading something about furniture and fixtures when we went through the information. So let's see if we can find that. Okay, so it says the company purchased $5,300 worth of furniture by borrowing on a note. Okay, so we borrowed money in order to buy furniture. Okay, so we said no cash changed hands. So when no cash changes hands, let's scroll down a little bit here so we can put this down at the bottom. When no cash changes hands, we have a non-cash transaction. So let's put this down here. Non-cash transactions. Okay, a non-cash transaction is when we exchange one item for another without spending any cash. So I'm going to say purchase furniture with note. Okay, with the note payable. And so that is $5,300. So essentially all we're doing is we're putting in a disclosure, right? Okay, so that way our readers know when they're looking at the differences, they're going to say, wait a minute, your furniture went up, but, you know, why isn't that in the cash flow statement? Okay, so let's scroll back up. Okay, All right, so that part's done, right? We took care of that one. So I'm going to cross off number 2. Number 3, the company sold furniture with an original cost of $2,000 and accumulated depreciation of $1,200 for $1,000. Okay, so let's see what's happening here. Let's do some calculations. Okay, so I had furniture cost $2,000 minus $1,200 of depreciation, so an $800 basis. I sold it for $1,000, which means I had a $200 gain. Okay, so how do we put this in my cash flow statement? Well, remember the cash flow statement is all about how much cash you received. So how much cash do we receive on the transaction? We received $1,000. Okay, now what section does that go in? If we purchased furniture, that goes in my investing section. Okay, or if we sold furniture, I'm sorry. So we sold furniture, and purchases of furniture would also go in there. Sold furniture, $1,000. Okay. Now what about this $200 gain that we calculated over here? What do we do with that? Well, that $200 gain is in my net income, right? And we already recorded the $1,000 of cash that we received from selling the furniture. So that $200 gain, this is a non-cash item. Remember, non-cash items are depreciation, gains, and losses. So we have to essentially remove this $200 gain from my $10,000 net income. So gain on sale, $200. Now how do I remove it? Well, if it was subtracted to calculate my net income, I'm sorry, it was added to calculate my net income, right? Because a gain is a positive on my income statement. So I'm going to subtract it to calculate my cash flow. Okay, so essentially what I'm doing is we're just removing this effect from my net income. Okay, so you're just going to do the opposite of whatever you did on the income statement. Okay, so I purchased $5,300. I sold furniture with an original cost of $2,000. So the difference between $5,300 and $2,000 is $3,300. That's my difference. Okay. Notice I didn't just say change in furniture and fixtures, right? In the investing and the financing sections, you actually have to explain what happened. So if you purchased furniture and you sold furniture, you have to put both of them in there. You can't just say change in furniture. Okay. We're trying to explain where the cash went. Okay. Now, accumulated depreciation changed by $1,200. Well, what do we know about depreciation? All right, it says here we removed $1,200 from the account. Let's do another calculation. We took out $1,200. Okay, but then our depreciation expense was $2,400, so then we added $2,400 to the account. So my change is $1,200, and if you look, my account went from -2 to -32, which is a difference of $1,200. So that accounts, right? My change was $1,200. Now what do we do with depreciation? Well, we just said a second ago, depreciation is another one of those non-cash transactions that we have to account for. So remember, depreciation is subtracted to get my net income. So in order to get rid of it, we're going to add it back in. We're going to do the opposite. So depreciation, $2,400. Okay, remember, we've got to put the full amount of the depreciation expense. So we're putting this amount here. Okay? All right, depreciation, done. We're moving right along. So next account, accounts payable. Okay, which section would accounts payable go in? Operating, investing, or financing? Okay, well, think about it. What do we use accounts payable for? We use it to buy office supplies, pay our heating bill, right? Pay for all those things that the company uses in operations. So my increase in accounts payable goes in operating. increase in AP. Okay, and what do we do with that increase? Well, think about it. Why did my balance go up? My balance went up because I'm not paying my bills, right? I'm not paying my accounts payable. So that means I'm not using cash. Okay, so if my balance on a liability goes up, that means I'm not using cash, which means I can use that cash for other things. So that increase of 1,300 increases my cash. Okay? All right, so that account is done. Next, notes payable. All right, well, we had something about notes payable in here, right? So let's see. We purchased the furniture, right, by borrowing on the note. So that increases my note by 5,300. And then it says I paid, let's see, number 4 says the company repaid 2,700 on its notes during the year. So that reduces my balance by 2,700, which gives me a change of 26. And that agrees to this. Okay, so my change was 2,600. So how do I account for that repayment on the loan? Okay, so I've already accounted for this. I need to account for this. So what section would a repayment on notes go? Well, that goes in financing. Okay, so I'm going to say repaid note payable. Try to squeeze that in there. Repaid note payable, and that would be $2,700. If I'm repaying a loan, what effect does that have on my cash? Is my cash going up or going down? My cash is going down when I repay a loan, right? Because how am I repaying it? With cash. Okay. No change in my common stock, and my additional information doesn't say anything about common stock, so we're done with that. Retained earnings. I find this is the account that gives students the most trouble because they don't remember how to calculate retained earnings. So let's try to remember. How do we calculate retained earnings? Retained earnings is beginning balance, okay, 1,000, plus my net income. Okay, how much is my net income? 10,000. Minus dividends, and that we don't know, right? We don't know what the dividends are. Okay, equals my ending balance of 3,100. Okay, so if I've got 11,000, right, because this is 11,000 total, minus something gives me 3,100. Okay, so if you do the math, my dividends are $7,900. Okay, so all we're doing is trying to figure out what's that missing number. Beginning balance plus net income minus dividends equals your ending balance. Okay, so now where would that go? Well, who do we pay dividends to? Okay, dividends go to shareholders, right? So that would go under our financing section. Paid dividends. Okay, and if I'm paying them, how am I paying them? I'm paying them with cash. So it makes my cash go down. All right, so now I've gone through every line on my cash flow, or on my balance sheet. Okay, so now let's see, do I get the changing cash of 3,500, right? This is what we're trying to get here. All right, so if I add up total of my operating section, I get $13,100. I got $1,000 from investing, and I used $10,600 in financing. Okay, so I might have to move my non-cash transaction here. I don't know if I have enough space. Okay, so let's see. All right, I had to pause the video for a second so I could figure out how to move that. We're always learning new things. Okay, so if I take, now I've got room for my change in cash. So let me get my pen back up here. Okay, so my change in cash. Oh, wrong color. There we go. All right, my change in cash. Okay, how do we get that? We're going to take the total from operating plus the total from investing plus the total from financing. Okay, and this is actually, that was negative. Okay, So 13,100 plus 1,000 plus negative 10,600 gives me a change in cash of $3,500. And hey, look, that is my change in cash on my income statement, or on my balance sheet. Okay, so one more thing we need to do. Okay, because readers don't necessarily understand, they're not going to pull out a calculator and say, wait a minute, how much is that change in cash? Okay, so what we're going to do is we're going to help them out. We're going to say our beginning cash was 4,000. So my ending cash is 7,500. And that ties right back to my ending cash on my balance sheet, right? $7,500 is my ending balance. Okay, so just to scroll back up here. Okay, so here's the top of my statement. I've got my heading, then my operating section where I've got net income, got my decreases and my increases in current assets and current liabilities. I've got my non-cash items like my gain on the sale and my depreciation. My investing section deals with items that a company purchases and sells, okay, in order to invest in themselves. So we've got the sale of furniture here of $1,000. Then the financing section, financing is long-term liabilities and equity transactions. So I've got my repayment of my note and paid dividends. That gives me my change in cash of $3,500. Add my beginning cash to that and gives me my ending cash. And then we also have a note down at the bottom, non-cash transactions. We purchase furniture with a note. Remember, that doesn't affect my cash, of $5,300. Well, I hope that helped. Good luck.